We recently released a report that outlines our long-term forecast once more. The numbers have increased significantly, but we still believe that the stock is incredibly undervalued. The reason for this is that two of our previous reports' assumptions have changed. First, our bull case for Tesla in our previous model predicted that it would lose a third of its market share, which it had in 2018, 177 worldwide, including China, as the Tesla killers entered the market. Today, we're going to reveal the closely kept secret that has investors eager to learn when to purchase Tesla stock and ride the rocket to millions of dollars. However, don't let that happen just yet. There's a catch. A turn to this story, a spice of suspense and a hint of mystery to keep you on the edge of your seats. This is not your typical stock market forecast. Rather, it's a historic development that has the potential to permanently alter the course of events in a world where dreams are dashed and fortunes are made. The Oracle of Wall Street, Cathie Wood, is holding a date that could lead to unheard of wealth. Everyone is wondering what that date is, what magic is involved, and how to take advantage of this once-in-a-lifetime chance to make millions of dollars. But before we dive headfirst into this mystery, let's take a quick peek at what's in store for you, and we'll solve the mysteries surrounding Tesla stock. Examine its astounding growth, analyze this high-stakes game, and demonstrate how artificial intelligence can put on your seatbelts and let Tesla take you to new heights. This is a story you won't want to miss, dear viewers, as we take you on a journey into the heart of the stock market where the stakes are high, the suspense is real, and the rewards are endless. But before we go any further, please make sure to show your support by liking this video and subscribing to Tesla Insights. Thanks. Let's get this video started. Traditional internal combustion engine cars are rapidly being replaced by electric vehicles, a trend that is picking up steam. Some voices argue that since the internal combustion engine market offers greater profitability, businesses should focus only on it. Furthermore, a commitment made to turn electric vehicles into a lucrative venture, but it's important to emphasize that others will find it extremely difficult to replicate Tesla's strategy, which involves lowering prices while maintaining production capacity. Viewers must realize that adopting a short-term outlook and advising Ford to remain focused on internal improvements using combustion engines is not a wise decision. The truth is that companies have no choice but to follow the path towards electric and autonomous vehicles, or else they run the risk of going out of business. The demand for electric vehicles is growing, and corporate fleets are adding a significant number of these vehicles. This transition is mostly because as firms like hers grow their fleets of electric vehicles, the maintenance expenses of electric vehicles are substantially lower than those of their gasoline-powered equivalents. The overall number of electric vehicles on the road is increasing more quickly than the initial transition to electric vehicles. This situation creates the possibility that energy companies will reassess their investments in the ecosystem of fossil fuels, which could cause volatility in oil prices. While this volatility may appear as lower highs and lower lows, it is actually the result of investments being withdrawn from the sector. Let's look at some data from the previous month. Car sales have showed a notable upward surprise, exceeding projections by 15.9 million units vs an expected 14.8 million units. This strong auto sales performance can be ascribed to various variables. We'll soon know the answers to these questions, as Tesla recently decided to lower its auto prices, which has caused some confusion. First, consumer confidence has remained surprisingly stable despite economic fluctuations. Second, manufacturers have continued to adapt to shifting market preferences, with many focusing on producing more fuel-efficient and eco-friendly vehicles. However, it's worth questioning whether this upside is a result of pent-up demand following supply chain disruptions, or if it's leading to an increase in dealer inventory. As a result of low demand is a legitimate concern. According to Tesla, it prices its cars strategically to maintain full production capacity. Even with these price reductions, Tesla's margins are still higher than Ford and GM's. So this isn't necessarily a sign of weakness, but rather a calculated move to keep the production lines operating smoothly. This pricing strategy sets Tesla apart from its rivals. In 2023, Tesla emerged as a dazzling star and won my favor. It's amazing. Its ascent, which shot up by an amazing 15 in just 6 months, was a sharp contrast to its dismal 2022 performance. I, along with many other retail and hedge fund investors, thrilled about Tesla's resurgence, which has seen the company's stock rise over 150 in just 6 months. However, over the last 30 days, the price of Tesla's stock has plummeted by almost 25, though it's important to note that it's still early days with only a month of decline to assess. Since July 17th, Elon Musk's company has been steadily shedding its market value, shedding over 23 from its peak, which reached nearly $290 per share. As of last night, Tesla stock closed at approximately $225 per share, marking its lowest price point since early June, just 2 months prior. This recent slide may come as an unexpected jolt to investors who have been riding electric vehicle and battery manufacturers' wave of success throughout the years. Still, Tesla had an incredible first half of 2023, so there's no need for undue concern. Effective cost management in electric drivetrain technology is one important aspect that enables Tesla to maintain reduced prices for every doubling of natural gas-powered vehicles have reached a mature stage and are no longer witnessing similar cost reductions. As a result, they are unable to match Tesla's pricing approach, placing significant pressure on their profit margins. Cumulative unit production costs have decreased by an amazing 28%. An interesting development occurred during Ford's most recent earnings call when they revealed that their electric vehicle division is expected to lose $3 billion in earnings this year. In contrast, their internal combustion engine cars are expected to generate a positive earnings per share, bit due of $7 billion, mainly due to their truck segment, which is expected to earn $6 billion. During our brainstorming session, this revelation gave rise to an intriguing viewpoint that was put forth. Effectively outsourcing its company strategy to its stockholders. By offering these financial data, these figures appear to suggest that Ford is inclined to prioritize profitability in the production of electric vehicles, while simultaneously concentrating on the more lucrative internal combustion engine market. Nevertheless, it is unclear if Ford will be able to effectively mimic Tesla's business tactics for investors deciding what to do next. So the question is this a wise purchase? The dip opportunity for the largest automaker in the world? It's important to note that historically, most dips in Tesla's shares have turned out to be favorable times for entry. In retrospect, this reminds us of examples like Cathie, who deliberately bought Tesla stock during 10 or even 20 downturns in 2022, and this year selling it when it rebounded by 20. Many others, including myself, have followed suit, seizing the opportunity to buy when Tesla's stock experienced a 20 drop. However, it's crucial to recognize that past success does not guarantee future results, a fundamental principle we all acknowledge. That said, that Tesla stock investors have an unbroken track record of profits. Though it fell short of the 1.5 million target, Tesla has a history of impressive growth, scaling from 350,000 vehicles in 2019 to 1.3 million in 2022. However, it is unclear whether it can sustain such rapid growth in the long run. We examine the significance of Tesla's high price-to-earnings P ratio by comparing it to industry titans like Toyota and General Motors. An alluring image of Tesla's future potential is painted by its dedication to fully autonomous driving and advancements in artificial intelligence. Do you believe Tesla can sustain its remarkable growth rate of 15% year-over-year? The company's trajectory is underscored by the recent advancements in AI, as stated in a tweet, regarding Tesla's current high price-to-earnings ratio in comparison to industry peers. What are your thoughts? Thank you for watching, and we hope to see you in our next videos. How much do recent advances in artificial intelligence enhance Tesla's potential? And finally, would you consider purchasing the current dip in Tesla stock? If you found this discussion to be insightful and thought-provoking, please consider supporting us by liking this video and subscribing to Tesla Insights